Microsoft Corporation, ticker symbol MSFT, is currently trading at $385.79 a share. Year to date, this stock is down about 8%, and over the last year, it's even down about 6%. What we're going to be doing is going through their most recent earnings and then taking it to my automated stock valuation spreadsheet. See if Microsoft is a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's just have let's quickly put in the ticker Microsoft or MSFT into the sheet, and this will load all the latest company financial data so we can have a deeper dive. But if we go to the earnings, this is the full year financial year 25 Q2. And if we scroll down, we have the top line, we have the revenue. So we have 3 months ended 23 versus 24. And then we have the 6 months ended as well, because that's how Microsoft do it. So it's split here into product, service, and other. And the product, it was actually down 18.9 to 16.2, but for service and other, up about 10.4 billion to 53.4 from 43. Overall, that's an increase from 62 to 69. If we scroll down a little bit more, we can see how they break it up. The different segments of revenue are productivity and business processes, intelligent cloud, and more personal computing. Productivity and business processes is a segment consisting of the products and services in our portfolio of productivity, communications, information services, and various other platforms. These are, for example, the Microsoft 365. We're talking about other things such as Power BI, SharePoint, Exchange, Teams, Security, Copilot. We also have LinkedIn as part of it here, and also the Microsoft 365 consumer products and cloud services, also Dynamics 365, the CRMs, things like that. Next, we have intelligent cloud. This is mostly Azure, the GitHub services, SQL Server, things like that. And then more personal computing is the Windows devices, the licensing, the gaming, and also Bing, Copilot, and their search and advertising. So they're the different segments. So we can see here the largest segment, currently this is 3 months ended 23 versus 24, and then we have the 6 months again. Largest segment here is still the productivity and business processes, up from 25.8 billion to 29.4. Next, we have the fastest growing segment, which is the intelligent cloud, the Azure side of it, or Azure if you're American, or Azure if you're not. 21.5 billion to 25.5. So this is the fastest growing, still the second largest, but looks like soon it will be increasing. More personal computing, relatively flat. And you can see here, this is the operating income. Most profitable still productivity and business processes, then cloud, then more personal computing. But you can see they're all growing massively. And this is how the revenue is broken up. So we'll go back to the automated stock valuation spreadsheet. 2.8 trillion in market cap, P of 31. Obviously, this is slightly different, but the market average is about 28. So slightly more than the market average, but overall pretty low relatively for a fast growing tech stock. Still fast growing despite its massive size. Earnings per share $12.41 and a beta of 0.92, meaning it's slightly less volatile in the market. Analysts say it's a buy, target price $506 a share. They do pay a dividend 0.85%, meaning you'll get paid $3.30. It's a very safe dividend, 24 billion. And in terms of the net income, very safe, and free cash flow, pretty safe as well. Buy before the 15th of May if you want to get paid. So let's have a look at the revenues. All-time highs, 256 billion. A massive jump up from 2023, or from the prior full year, obviously. Things are looking good. If we look at the stock price over those similar times, we go over the last 5 years. 2023, it was, even $300 a share. So it is up quite a bit since then, but relatively, this is a massive jump to all-time highs. Net income, similar story, most profitable year ever, 92.58 billion, by then some, massive profitability. Free cash flow, this is where it changes slightly, 55.83 billion, down from 23 and 24. But if we do look at the operating cash flow versus capex, operating cash flow is all-time highs. They've got big capex spend at the minute. If it comes down to prior levels, around that 25 billion mark, this would obviously operating cash flow to the same. We would have massive free cash flow, somewhere in the region of 90 billion. So right now, it's in terms of the free cash flow ratio is a bit lower, but capex spend is very high. Shares outstanding, they're buying back shares. Microsoft always have, rewarding shareholders that way. So let's have a look at the discounted free cash flow model. This way of valuing stocks, looking at their future free cash flows, discounting them to today's value, and let's see what we can see. So currently it gives us a price of $310 a share. We're expecting 285 billion, 316 billion of revenue in the coming years based on the averages. Let's see what analysts are saying. 277, 316, so pretty close. Net income margins, pretty happy with those as well. Okay, so this is what I'm saying. As we said before, free cash flow. So currently we're about 85%. It puts us at about 310, and this was the big capex spend. If that puts us at, where's the free cash flow? 90 billion, yeah. So if we would increase that to their prior numbers about 90%, it would put us at 327. And then again, if you can go back to those 2020 numbers, it would be 364. So still not a buy on the discounted free cash flow model, but it shows that with the capex spend, once they cut that, the free cash flow, well, it's massive generation free cash flow once again. Dividend discount model, we'll have a quick look at that. So they grow at about 10%. Let's just bring that down. Yeah, see, dividend discount model, I don't really like it for certain stocks, but you can see here, it says it's a massive buy. It says it's way undervalued at $700 a share, but you can see here that the way they're growing their dividend about 10% a year, it's very, very good. Bankground formula for intrinsic value. This looks at earnings per share, P of a non-growth company, AAA bond yield, corporate bond yield. AAA bond yield is at 5.32, and Microsoft's expected growth over the next few years is 14%. They're actually expecting less growth than the S&P 500, which is quite interesting. They'll put this at 14%, $230 a share. So for them to be able to buy, it would need to be growing at 25-30% on the Bankground formula for intrinsic value. So a lot of the models saying it is not a buy. So that's why I like to look at the comparable company model. So we're valuing stocks looking at their competitors of similar size in industries. So we're going to do a few here. The first one I think we'll do is Apple, ticker symbol AAPL. We'll do Google, and we'll do Amazon. I think they're, in terms of size, revenues, profits, all things like that, they are the most similar. So let's see if it is undervalued based on these. Enterprise value, they're all, 2 trillion nearest damn it or more. Apple being the largest, then Microsoft, Amazon, and Google. Revenue, Microsoft is actually the lowest, 256 billion compared to all these. Revenue growth rates, all very high. Apple's actually the slowest. EBITDA, Microsoft is the highest. Profitability, Microsoft is nearly second highest, but we'll say third. Margins, highest margins, 36%. Apple and Google in the high 20s. Amazon, obviously, with a lot of their revenue coming from the e-commerce side, not necessarily the AWS. You can see that their profit margins are a lot lower. Price to sales market average is around about 2.9 at the minute. Microsoft's the highest. Price to book market average is about 5. Microsoft, middle of the pack. PEG, Peter Lynch's price to earnings growth. Ideally, you want this under 1. None of these are, but you can see they're all pretty close. EV to revenue, EV to EBITDA, PE, and forward PE. EV to revenue, it's the highest. EV to EBITDA, middle of the pack. PE, middle of the pack towards the bottom. Actually, you can see Google looks quite undervalued in terms of PE and in terms of forward PE. So it's putting its prices, buy on the PE, not a buy on anything else. Puts about $320 a share. So even compared to its competitors, looks a little bit overvalued at the minute, but I would disagree with this. So the other one I want to compare this to is more sort of traditional companies that are similar, not as big, but we'll just do IBM, Oracle, and we'll do CRM, Salesforce. Similar companies, obviously not the size of Microsoft. As you can see here, Microsoft is probably 10 times and 5 times the size of these. But I won't go through all the numbers here, but you can see that puts it closer to about fairly valued, $380 a share. Only the forward PE is lower. These have a lot lower forward PEs, but in terms of EV to revenue, it is the highest. EV to EBITDA, a buy. PE is a buy. So overall, I do think Microsoft is undervalued, and the models disagree with that, which is quite interesting. But it is, yeah, I think the fact the stock has done relatively nothing over the last year. You can see Apple up 22%, Microsoft up, S&P 500 is up over that time. Obviously, over the last 5 years, beating the market, definitely. But it does look like this is a good buying opportunity for Microsoft. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon. $4 tier for the sheet. And I'll catch you guys next time.